Next we have monetary and fiscal policy end of chapter questions. Question number 1. As the reserve requirement increases, the money multiplier increases, decreases, or remain the same. So I'm sure you would have gone through the theory. Money multiplier is 1 upon reserve requirement. So basically there is an inverse relationship between money multiplier and the reserve requirement. So if reserve requirement increases, the money multiplier would decrease. So that would make B to be our correct option. Next, which is most accurate statement regarding the demand for money? Precautionary money demand is directly related to GDP. That is true. Precautionary money balances are held to provide a buffer against unforeseen events that might require money. So precautionary balances tend to rise with the volume and the value of transactions in the economy. So therefore, they rise with GDP. Look no further. A is straightforward the right answer. Alright, next question. The following exhibit shows the supply and demand for money. There is an excess supply of money when the nominal rate of interest is. Well, there would be excess supply of money when the nominal interest rates are I1, because at this rate, as you can see, there is excess supply. So basically, you can see here M0 minus M1. This represents the excess supply of money. So what will happen then? So we got the answers. I1 is the right answer. So this would indicate that there is excess supply of money. What will happen? Economic agents, they will seek to buy bonds with this excess money balances. Now what would happen? This would force the price of the bonds up, and accordingly it will bring the interest rate down back to this level. So right now we got the answer. B is the answer, but that's the subsequent step that will happen. Alright, moving on. According to the theory of money neutrality, money supply growth does not affect variables such as real output and employment in the long run, short run, long and short run both. According to the theory of money neutrality, an increase in money supply ultimately leads to increase in price level, and it leaves real variables unaffected in the long run. So that makes A to be the correct option. Next, which of the following best describes a fundamental assumption when monetary policy is used to influence the economy? The basic fundamental assumption. Financial markets are efficient. No, this is not the fundamental assumption. If the money were neutral in the short run, monetary policy would not be effective in influencing the economy. Money is not neutral in the short run. This is the fundamental assumption. Official rates do not affect exchange. This is incorrect as well. So that makes B to be the correct option. Next question. Monetarists are most likely to believe. Well, by definition, monetarists believe that prices may be controlled by changing the money supply, by manipulating the money supply. So money supply can impact the price level. That's the belief of monetarists. So that means inflation, that's the price level, can be affected by changing the money supply growth rate. That makes B to be the correct option. Next, the proposition that the real interest rates is relatively stable is most closely associated with, clearly this is Fisher effect. The Fisher effect is based on the idea that real interest rate is relatively stable. Changes in nominal interest rates result from changes in expected inflation. That's what we have discussed earlier. So next question, that was A. Which of the following equations is a consequence of Fisher effect? Yes, nominal interest rate is equal to real interest rate plus expected rate of inflation. Look no further, it's A. And normally when we write the equation, it's 1 plus nominal rate is equal to 1 plus real rate multiplied by 1 plus expected inflation rate. Nonetheless, A is the right answer, and A it is. Central bank would typically be most concerned with costs of low level of inflation that are anticipated. That's fine. It's not a cause of concern. Moderate levels of inflation that are anticipated, not a cause of concern. Moderate levels of inflation that are not anticipated, unexpected, right? That's the cause of concern. And why is that? Unanticipated inflation has greater cost than anticipated inflation. All right, moving on. Monetary policy is least likely to include setting an inflation rate target. Yes, it does. Changing an official interest rate. Yes, it does. Enacting transfer payment program. No, this is transfer payment program represent fiscal, not monetary policy. So that makes C to be the correct option. Which role is a central bank least likely to assume? Lender of last resort, yes. Supplier of currency in the economy, yes. Sole supervisor of the banks. Well, this is not a role that all central banks assume. Normally they do, but this is not the role all central banks would assume. When it is the central bank's role, the responsibility may be shared with one or more entities, not just the central bank alone. So yes, central bank is the bank of bankers, but despite that, this is not the sole role they may have. So that makes B to be the correct option. Next, which is the most accurate statement regarding central banks and monetary policy? Central bank activities are typically intended to maintain price stability. This is a good statement. This is right. That's right. Monetary policies work through the economy via 4 independent channels. Well, they are not the channels. Basically, they are the transmission channels of monetary policy, and they are not independent. They are not independent channels. And then finally, commercial and interbank interest rates move inversely to official interest rate. Wrong. They move in the same direction. So that makes A to be the correct option. When a central bank announces a decrease in its official policy rate, the desired impact is an increase in the investment. Yes, when the interest rate fall, this would result in more attractiveness for investment projects. Investment is inversely related with the official policy rate. Which action is a central bank's least likely to take if it wants to encourage businesses and households to borrow for investment and consumption purposes? Least likely to do. Yes, C will be done because it will increase money supply. Purchase long-dated government bonds. Yes, this is what the central bank would do. But sell long-dated government securities. Such actions would tend to constrict the money supply and increase interest rates. So it will purchase so as to increase money supply, long-dated government bond. It will purchase mortgage bonds to increase money supply. But selling long-dated government security, that will reduce money supply. This is least likely to be done, and hence is our right answer. A central bank that decides the desired level of interest rates and inflation and the horizon over which the inflation objective is to be achieved is most accurately described as being target independent and operationally independent. Correct. The central bank describes its target inflation independently because it sets its own targets, targeted inflation rate, and it is also operationally independent because it decides how to achieve its target. The time horizon is decided. So that makes A to be the correct option. Look no further. A country that maintains a target exchange rate is most likely to have which outcome when its inflation rate rises above the level of inflation rate in the target country? Again, a country that maintains a target exchange rate is most likely to have which outcome when its inflation rate rises above the level of inflation rate in the country. So to control inflation, there is likely to be a short-term increase in interest rates. A is the correct option. A central bank's repeated open market purchase of government bonds, if the central bank keeps on purchasing government bonds, what will it do? Decrease money supply, or rather it will increase. Is prohibited in most countries? No. It is consistent with an expansionary monetary policy. True. The purchase of government bonds via open market operation, it increases the money supply, and it is consistent with an expansionary monetary policy. In theory, setting the policy rate equal to the neutral interest rate should promote, yes, stable inflation. Neutral rate of interest is that rate of interest that neither stimulates the economy nor slows down the economy. So the neutral rate should be consistent with the stable long-run inflation. So that is the right option. Okay, next, a prolonged period of an official interest rate very close to zero without an increase in economic growth most likely suggests what? Quantitative easing must be limited to be successful. So, well, bringing official interest rate close to zero, sometimes even below zero, slightly below zero, and there is no economic activity, there is no economic growth, which means that there may be limits to the effectiveness of monetary policy. Despite these low rates, there is no economic growth, which means that such actions have their own limits, right? So central bank would decrease in an official interest rate to this low level, but despite that, there is no economic activity. So we can say that there are limits to monetary policy. It won't work every time. Next, raising the reserve requirement is most likely an example of which type of monetary policy? We discussed that in detail. It's contractionary. And when you lower the reserve requirement, that is expansionary policy. So right word C is the right answer. So raising the reserve requirement should slow money supply growth, and that makes C to be the correct option. Which of the following is a limitation on the ability of central bank to stimulate growth in the periods of deflation? Well, this could be very serious. Deflation basically is a very serious challenge against monetary policy, because once the central bank has cut nominal interest rate to zero or slightly below zero, they cannot be further cut, they cannot be further reduced. So the fact that interest rate cannot fall significantly below zero, that makes C to be the correct option. This is the limitation, monetary policy. The least likely limitation to the effectiveness of monetary policy is that the central bank cannot control amounts that economic agents deposit into the bank. Yes, true, this is the likely limitation. Central bank cannot regulate the willingness of financial institution to lend. Absolutely right. This is again a limitation. But central bank cannot accurately determine the neutral rate of interest. This is not a limitation. The inability to determine the exact neutral rate of interest does not necessarily limit the power of monetary policy. So this is least likely. A. Next, which of the following is most likely example of tool of fiscal policy? Central bank purchasing of government bonds, that's the monetary policy. Regulation of payment system, monetary policy. Public financing of a power plant, that's fiscal policy. A. Public financing of a power plant could be described as a fiscal policy tool to stimulate investment. The least likely goal of government's fiscal policy is to redistribute income and wealth. This is a goal. most likely a goal. Influence aggregate national output, this is a goal. Ensure stability of the purchasing power of its currency, this is least likely. Ensuring stable purchasing power is the goal of monetary rather than fiscal policy. Fiscal policy, as we have discussed, involves the use of government spending and tax revenues to affect the overall level of aggregate demand and hence the level of economic activity. So that makes C to be the correct option. Given an independent central bank, monetary policy actions are most likely than fiscal policy actions to be implemented quickly. Absolutely right. Fiscal policy, there is a significant lag, but monetary policies, they can be done much more quickly. Monetary actions may face fewer delays to taking action than the fiscal policy, especially when the central bank is independent. Fiscal policy takes time. Laws are to be enacted before it could be implemented. So that makes A to be the correct option. Which statement regarding fiscal policy is most accurate? To raise business capital spending, personal income taxes should be reduced. Well, that might require corporate tax rates to be reduced, not the personal. So this is incorrect. An increase in the budget surplus is associated with expansionary fiscal policy. Well, that's rather contractionary. Incorrect. Then it has to be B. Cyclically adjusted budget deficits are appropriate indicators of fiscal policy. True. Cyclically adjusted budget deficits are appropriate indicators of fiscal policies. These are defined as the deficit that would exist if the economy was at full employment or full potential employment. That makes B to be the correct option. The least likely explanation for why fiscal policy cannot stabilize aggregate demand. Least likely explanation. Private sector behavior change over time. This is a good explanation why it cannot stabilize aggregate demand. Correct. Fiscal policy focuses more on inflation than on unemployment. Again, that's a valid explanation. Why fiscal policy cannot stabilize aggregate demand is that policy changes are implemented very quickly. Wrong. Fiscal policy takes time. There is a lot of lag there. Implementation lag. Impact lag. Fiscal policy subject to recognition, action, and then impact lag. So that's not the likely explanation. B is the least likely explanation, hence our right answer. Which of the following best describes or represents a contractionary fiscal policy? Public spending on high-speed railway, that is expansionary. Temporary suspension of payroll taxes, that is expansionary, more disposable income. A freeze in discretionary government spending, this is contractionary. A freeze in discretionary government spending is an example of contractionary fiscal policy where government spendings are reduced. C is the right answer. Next, a pay-as-you-go rule which requires that any tax cut or increase in entitlement spending be offset by an increase in other taxes or reduction in some other entitlement spending is an example of which fiscal policy? Neutral, because increase is being offset by decrease. So accordingly, there would be no net impact on the budget deficit or surplus. So it's a neutral policy. That makes A to be the correct option. Quantitative easing, that is the purchase of government or private securities by the central bank from the individuals and or the institution, is an example of which monetary policy? Expansionary, more money. B is the right option. Quantitative easing is an example of an expansionary monetary policy stance. It attempts to spur aggregate demand by drastically increasing the money supply. B is the right answer. The most likely argument against high national debt level is that the debt is owed internally to fellow citizens. Incorrect. National debt could include your international debt or debt from the local banks, not fellow citizens. So incorrect. They create disincentive for economic activity. Yes, this is true. This is true because the belief that high levels of debt, if debt level is high, which means there will be more taxes in the future, so that the debt could be serviced, this would lead to disincentive to economic activity. This is correct option. The most likely argument against high national debt level is that they may finance investment in physical and human capital. That goes in favor, not against. Hence, B is the right option. Which statement regarding fiscal deficit is most accurate? Fiscal deficit. Higher government spending may lead to higher interest rates and lower private sector investment. That's true. Government borrowings may compete with private sector borrowing, crowding out for investment purposes. Correct. Look no further. A is the right option. Next question, number 33. Which policy alternative is most likely to be effective for growing both the public and private sector? Easy fiscal, easy monetary policy. True. If both fiscal and monetary policies are easy, then the joint impact will be highly expansionary. Easy fiscal policy will expand the economy. Easy monetary policy will expand. So they will move in the same direction jointly, leading to a high rise in aggregate demand, low interest rates, and growing private and public sector. A is the right option. And that completes your EOCs on monetary and fiscal policy.